Assalamu alaikum wa rahmatullahi wa barakatuh. Welcome back after the break. Just before going to the break, we were discussing about the corporate governance in the Islamic banks, and I was going to tell you about the Sharia board's role as to how to protect the interests of the depositors. In a conventional bank, we have learned earlier that the conventional bank will accept the deposits at a predetermined rate of interest and will invest those deposits by way of lending further down, and the interest rate at which the conventional bank will take the deposit will be lower, and the interest rate at which they will lend the money will be higher, and sometimes the gap becomes too much. So the difference actually becomes the profit or earning for a conventional bank. But whilst the conventional banks use their discretion to increase the interest rate anytime they would like to have it, like we saw recently in the Gulf countries that the conventional banks, as soon as the crisis started biting, they started increasing their lending rates. So on one side, the depositors have been put at a certain fixed rate. On the other side, as and when the opportunity arises, the conventional banks keep on increasing their interest rate on their lending to the borrowers. Sometimes it really becomes back-breaking for the borrowers because they may not be able to manage that. They may not be able to afford to have this increasing interest rate, but because they are stuck, so they have to live with that. So when we talk about the interest rate in conventional bank, here we're talking about the fixed interest rate. Compare it with the Islamic bank's model. Islamic bank's model is that the Islamic bank will receive the deposits from the depositors on a trust basis. Islamic bank will receive the possession of the money, whilst the title of the money will remain with the depositors. So it means they are basically investing their equity. The Islamic bank will have share capital. They may have used the share capital to some extent in establishing themselves because, as I mentioned earlier, an Islamic bank must first establish itself as an entity before it goes to the depositors and say, I'm ready to be your mudarib. So it means that you have to comply with all the local regulations, the licensing authority regulations, the central bank or the Ministry of Finance or Economy, or any other local government regulations. So once you have completed all the regulations and everything, then you will say, okay, this is the Islamic bank we have established. We have the license from the regulatory authorities to start, and the shop is now open, and we will welcome the depositors. Now, whatever you have done so far, you have actually been investing your share capital, and you have been setting up the branches, the head office, the infrastructure, hiring people. So some amount of the capital has been used. Whatever is the remaining amount of the capital will be invested along with the money which comes from the depositors. So there is a common pool, or it's a common pot, for example, where the depositors are putting their money and the shareholders are also putting their money. So depositors and shareholders are actually like, shareholders are also like any depositor. So it's basically a partnership between them, that they are investing their money through the common pool. Okay, so this is the common pool concept in the Islamic banks. Now, when we talk about the common pool, fine, depositors have put their money, shareholders, whatever little bit they can invest, they have also invested. Who will manage the common pool? When it comes to managing the common pool, obviously the depositors have brought their money to the Islamic bank because they cannot invest on their own, because they do not have the expertise to invest. This is their savings. If they had the expertise, they would have started something on their own. They would not come to the Islamic bank. So the Islamic bank is saying, we have the expertise, we have hired the people, we have the infrastructure ready, and we have all the paraphernalia of an Islamic bank readily available, and now we will start doing the business. So in this case, the money coming from the depositors basically will be the lifeline for an Islamic bank, because this is a great chunk of money, a big chunk of money. When you compare it with the money which is put by the Islamic bank, as a portion, as a ratio, it will not be more than 5 to 7% or maybe less than that. But 90 to 95%, this will be the depositors' money, which will basically be invested in the Islamic bank's business. So the Islamic bank has been appointed by the depositors while they are signing the deposit contract as a fund manager or the mudarib to manage their money for them so that they can get the halal return. So the Islamic bank actually has got two roles in the Islamic bank, the Islamic bank management or the shareholders. One is that they have invested their share capital, whatever is the residual after they set themselves up, into the common pool. And then the second one is that they are the managers of the whole common pool. It means their money gets completely mixed up with the money of the depositors and it becomes inseparable. And then from that common pool, the money is being taken out and invested here and invested there. In some cases, it is the sale contract, murabaha, istisna, salam, ijara. In some cases, it is investment, for example, the mudarba or the musharka. Ideally, the Islamic banks have worked on a model whereby there's only one door through which they get the funding, which is the mudarba. It means they sign the mudarba contract with each and every depositor. And there are several doors through which the investment goes. And these several doors could be, as I mentioned, the sale contracts and the investment contracts. Earlier also I mentioned that when we talk about the conventional banking, which is almost 400 years old, we see that there is only one product that they are relying upon for the last 400 years. So there's a stagnation of ideas. And what is that one product? That one product is the loan with interest. For the last 400 years, all the conventional banks have only this product, which is loan with interest. When we compare it with the Islamic banks have got sale contracts, they have got investment contracts. And then there is a structuring, which is basically to combine two different contracts to make a third structure, which is suitable to the financing requirements of a customer. So we're talking about a stagnation in the conventional banking whereby they're relying for the last 400 years on one product, which is the loan with interest. And if you open the wrapper, inside this is the only product. If you talk about the personal loan, it is loan with interest. Car loan, it is loan with interest. If you talk about the trade loan, it is the same. Overdraft is the same. Credit card is the same. Project loan is the same. Bonds is the same. Go to the higher level, bonds, for example, is the same. So here, the product is only one and only the wrappers are being changed. We talk about the Islamic bank and we see that there is no scarcity. We have the investment contracts and we have got the sale contracts. If I count, there are about 5 or 6 different kinds of investment contracts, and then there are different kinds of sale contracts. And then you can, for example, there is a project requirement. A project needs to be established, and the expansion of a project or a greenfield project for that matter. Obviously, one structure will not serve the purpose. So what we do is that we take 2-3 structures and we try to come up to the funding requirement of the client whereby certain funding is being done in certain manner, the return is coming out from another structure. So this is, structuring is basically an art and also at the same time it is science. Whereas we don't have this kind of activity, high intellectual level in conventional banking. Coming to the point, the corporate governance, the Islamic bank has established itself, business started, shop is running, the investment has been made, and then the returns are coming out to the common pool, and then we have got the common pool profit distribution. But before that, very important point which I would like to explain is that the role of the Sharia board in not only overseeing as to how the bank is being run in a Sharia compliant manner so that all the shareholders, all the depositors, and the employees also should get the halal risk. It means that the shareholders will get the halal return, the depositors will get the halal return, the employees who are working there also, so it becomes a big responsibility for the Sharia board to look at all the areas of Islamic Bank to ensure that everyone is getting the halal risk. Thank you very much for joining us for this episode. We'll continue with this discussion, inshallah, in the next episode. Assalamu alaikum wa rahmatullahi wa barakatuh.